because the government, we're told, is considering taking out $1 billion loan from the World Bank. According to the Business Day, this is a strategy to take advantage of cheaper loans in order to support the COVID-19 pandemic response and other economic reforms. Let's unpack the possible implications now, bringing economists with Pan-African Investment and Research Services. That's Dr. Iraj Abedian, live to us via our video link this morning. Doc, it's great to see you. Thanks as always for making time to speak to us.
Good morning, and to our viewers.
Yeah, it's interesting to learn from the Business Day that part of what government is doing here is, quote-unquote, take advantage of cheaper loans from international institutions over the next 3 years. However, let's be clear, this is still money that has to be paid back at some kind of interest, I imagine. So the question becomes, does the opportunity cost make sense?
Yeah, I think, and not only the point that you raised about paying it back with interest, but also depending how it's structured, it also has foreign exchange risk to it. In other words, we get $1 billion now. Let's say it's a 5-year or a 10-year, and the government has to declare that. Let's say it's a 10-year bond, and in 10 years' time, when you pay $1 billion, Rand today is, for example, at 17 Rand per dollar, it may be at that time 25. So that's another cost to the fiscus, to the national economy. So these foreign borrowings, whether it's from the bank, World Bank, or from the capital market, has a cost. And that brings us to the issue, to the real issue, and that is the fact that, as you know, South Africa is now a sub-investment grade destination, meaning it's a junk status, and in effect it means its cost of borrowing in the global capital market has risen sharply. And that is a real cost that needs to be addressed, whether we borrow from the World Bank or from the capital markets.
Right. What we've also learned is that not all debt is bad debt. It only becomes really difficult in a context where, as you've mentioned, the conditions aren't right for you to borrow that money, and it also depends on what you plan to spend that money on.
Absolutely. Debt can be very, very enriching, very good. In fact, in business, debt is almost a necessity for building businesses and creating new wealth. However, what we do with it is absolutely critical. For the national economy, unless the national government can prove that the money borrowed, whether from the World Bank or from the capital market, is going to build the economic structure, economic infrastructure, to raise the capacity of the economy, to generate more revenue, more jobs, more welfare, so that in 10 years' time, when the bonds are due, the economy is far more robust than when we started borrowing. It's very similar to borrow at the individual. If you borrow your capacity, your businesses, and your degree and become prospect of better earning, that's fantastic debt. If you're borrowing to have a party or to make up for your mistakes, you're digging a hole for yourself.
Yeah. There's also this ongoing concern around the relationship that countries like South Africa would have with these multinational institutions in a context where we have debt that we owe to them. You know, real fears that in some ways we give up part of our sovereignty because of the conditions that come with these particular loans. I wonder how concerned we should be about that, especially because we already owe money to the World Bank.
I think we need to be very concerned, especially if, and I think you're referring to the conditionalities that comes with this type of loans, be it from the World Bank or from the IMF, and those concerns are very real. They could be very devastating. But the real cause of those conditionalities is that the countries get junk status. They cannot go to the capital market and borrow cheaper. Remember, South Africa not so long ago, 2012, a decade ago, used to borrow from the capital market cheaper than what it could borrow from the World Bank or from any other multilateral institutions. Therefore, why? Because it was an investment-grade destination. The economy was performing at 4% per annum. Government tax revenues were robust. And that was because, and that in that situation, the capital market was prepared to lend to South Africa at cheaper rates. That is what we need to aim at. The conditionalities are going to be inevitable. And the more we borrow from the World Bank, which means the lazier we get to deal with regaining our investment-grade destination, the more comfortable the politicians become in the short term. And I emphasize in the short term. If they take a 10-year view, however hard it might be to regain our investment-grade status, the better it is for the nation, but not for the politicians and for those who have to take the tough decisions in order to make the country fit for regaining its sovereign rating as an investment destination. I think that is where the challenge for South Africa is, and the more we get comfortable and borrow from the IMF because of COVID, borrow from the World Bank, we're getting in a slow sinking into a hole that will be more and more difficult to get out of.
Absolutely. Plenty to think about as these talks continue. Thanks for helping us connect the dots. Dr. Iraj Abedian, an economist with the Pan-African Investment and Research Services. Once again, thanks for your time.